AMD stock is under pressure despite revenue growth topping 50%, but the CEO is signaling that Wall Street is fundamentally misjudging the company's AI trajectory. AMD chair and CEO Lisa Su sat down with Jim Cramer on CNBC to address the market's skepticism following their latest quarterly results. By the end of this video, you will understand why Su believes the data center business is poised to shatter current analyst projections and how a massive expansion in high-performance computing is set to redefine the competitive landscape through 2030. Let's hear what Lisa Su has to say first, then I'll give you my own reaction breakdown to what she said.
Lisa, first I want to congratulate you. I think people don't understand that your stock is up so dramatically that it certainly makes sense that there could be a little bit of profit-taking. It has far exceeded NVIDIA's stock price this year. So I think it's important that we start out by saying there was really no disappointment here that I could see.
Well, Jim, great to be here with you this morning. Great to see David and Carl as well. And yeah, it was a very strong quarter for us. We grew revenue over 50% year on year, and we're seeing just tremendous momentum, especially in our data center business, where folks need a lot more AI compute, and we have some great products coming. So very excited about the trajectory of our business and the momentum that we're seeing going into the second half of the year.
Let's go over something that was said in the call. I think that the analysts in the call, for the most part, were a little too negative. And at one point you say, look, I think you're hearing from us is that the data center AI number is probably too low. And maybe back to, and then mention an analyst question without going into exact numbers. I think the notion of over 100% should consider be well over 100%. So in other words, it's entirely possible that the analysts may not have heard exactly how strong your business is going to be.
Well, Jim, actually what I would say is we are in an extraordinary time for AI compute right now. We just updated our overall market numbers. We see the market for overall computing and high performance and adaptive computing going up to over $2 trillion as we go through 2030. And with all of that information, we wanted to reframe where our business is. And the fact is, our data center business is accelerating. We're extremely excited about our foundational model, large strategic partners like OpenAI and Meta, and we just added Anthropic to the mix there. And this is a case where, we do see our data center business growing well over 100% as we go into 2027. And those are just very large numbers when you think about, the base that we're on top of.
But also, I want to talk about CPUs. You guys have, as you taught me, you're just the CPU company. And it does seem that some of these analysts, I'm just harping on the analysts because the stock's down today. Some of these analysts are somehow thinking that your CPU business, because this lower margin, is going to hurt you. I don't see how that's possible. I think it's just 100% additive. Am I too bullish about AMD?
Well, I think, Jim, you're right on a couple of aspects. What we have seen in the AI market over the last, I would say, 6 or 7 months is really an inflection in demand, and especially in the CPU market. So what we're finding is as AI is becoming more useful for people, as we're using more agents, as enterprises are using, more of their workloads from, let's call it what was experimentation into now production workloads, people need a lot more CPU compute as well as, GPU compute. And we are the leaders in CPU compute. We're very, very proud of our technology stack. We just announced our next generation. Venice has launched. And, as you know, our Italian cities very well. Venice is leadership across every aspect of compute, whether you're talking about the highest performance or the most overall performance per core. Those are areas where, we just lead. So, we're excited about where the market is because the market needs a lot more compute. And we're even more excited about just the overall positioning in the market because our product portfolio is so broad and strong.
So, Lisa, as IT budgets get assembled for next year, how should people think about the enterprise state of mind? I mean, is it about sort of cost discipline and trying not to token max and being wary of our potential ROI? Or is it about just breaking some stuff and hitting the pedal to the metal?
Well, Carl, it's a great question. I think it's a little bit of both. And, the way I see it, spending time with a lot of CEOs and CIOs right now, the desire is to truly use AI as a tool AI is a tool to help all of our businesses become more productive. And there is a good amount of experimentation where you're trying to figure out which is the right model that will get the best outcome from a business standpoint. But we are also in the place where, the AI costs are getting so large that everybody has to manage, just like you manage your employee costs, you have to manage your AI costs. And I'm a big believer in there will be all kinds of models that are important as you go forward. And that includes using the largest foundational models, as well as using open models and let's call it smaller and medium-sized models as you think about all the different use cases. So I think the state of mind in enterprise today is how do I take advantage of AI while ensuring that I'm managing it for what will be significant growth going forward.
Lisa Su's claim that AMD, ticker symbol AMD, will grow its data center business well over 100% by 2027 shows how the AI hardware landscape is shifting away from a single-player monopoly, a promise of diversified compute power we will unpack today. This breakdown examines Su's recent CNBC interview on Squawk on the Street, where she defended AMD's valuation against critics. But the real story isn't just the GPUs, it's a massive, overlooked shift in legacy processors that might catch Wall Street completely off guard. The conversation kicked off with Jim Cramer tackling the immediate elephant in the room, AMD's stock performance and the underlying market sentiment. Cramer pointed out that despite AMD's dramatic run-up, there was a wave of profit-taking dragging the stock down on the day of the interview. He argued that the market's reaction was disconnected from reality, stating that the analysts on the earnings call were being far too negative. In Cramer's view, there was no actual disappointment in the numbers, and he suggested that Wall Street was failing to grasp the sheer strength of AMD's forward-looking business. He wanted Su to address this apparent disconnect and clarify whether the market was missing the forest for the trees. Su seized on this opening to reframe the narrative, pointing directly to the hard numbers. She noted that AMD had just delivered a highly robust quarter, highlighted by a massive 50% year-on-year revenue growth. The primary engine behind this momentum, as she explained, is the data center business. Su pushed back on the conservative models put forward by Wall Street analysts, suggesting that their estimates for AMD's AI-related data center revenue were simply too low. Rather than getting bogged down in quarterly minutiae, she introduced a staggering new projection. AMD now views the total addressable market for high-performance and adaptive computing as climbing to over $2 trillion by the year 2030. To ground this massive number, she pointed to their deepening alliances with top-tier strategic partners, specifically highlighting OpenAI, Meta, and their newest addition, Anthropic. Based on this traction, Su asserted that AMD's data center business is on track to grow well over 100% as they head toward 2027. Looking at these claims, my read is that Su is playing a very sophisticated game of long-term expectations management. When a company references a $2 trillion total addressable market, it is easy to dismiss it as standard corporate optimism designed to soothe anxious shareholders. But if you look closely at the partners she named, the picture changes. Adding Anthropic to a roster that already includes Meta and OpenAI is a massive win. It proves that AMD's Instinct MI300X platform is not just a theoretical alternative to NVIDIA, ticker symbol NVDA, but a commercially viable one that is actively being integrated into the world's most demanding AI clusters. However, we have to look at the execution risk. Growing a data center business by over 100% on an increasingly large base requires flawless supply chain execution. AMD does not manufacture its own silicon, it relies heavily on TSMC. If packaging capacity remains constrained, AMD's actualized growth might lag behind Su's ambitious projections, regardless of how high the demand is. This tension between explosive demand and physical capacity constraints was the perfect bridge for Cramer to steer the conversation toward another critical, yet highly misunderstood part of AMD's portfolio. Like the video and subscribe to the channel if that was worth your time. Cramer then shifted the focus to AMD's legacy strength, central processing units. He noted that some Wall Street analysts were actively penalizing the stock because they believed AMD's CPU business, which typically carries lower gross margins than high-end AI graphics processing units, would act as a drag on the company's overall financial profile. Cramer expressed deep skepticism toward this analyst narrative, arguing that CPU growth should be viewed as entirely additive to the business rather than a margin-diluting headwind. He put the question directly to Su, asking if his bullishness on the CPU front was misplaced, or if the analysts were fundamentally misinterpreting how the modern data center architecture actually operates. Sue's response was a masterclass in hardware system architecture. She strongly validated Cramer's perspective, explaining that the industry has experienced a massive inflection in CPU demand over the past 6 to 7 months. To explain why this is happening, she drew a sharp distinction between the initial phase of the AI boom and where we are today. The early stage of the cycle was dominated by experimentation, companies buying up GPUs to train models and run pilot programs. But as enterprises transition these AI applications into actual production environments, the infrastructure requirements change. Sue explained that running complex AI agents and scaling enterprise workloads requires a massive amount of traditional CPU compute, alongside specialized GPU accelerators. She then highlighted AMD's next-generation Venice processor platform, claiming it delivers leadership across every key metric, including total compute performance and performance per core efficiency. Far from being a low-margin drag, she framed their CPU dominance as a core competitive pillar. My analysis of this exchange suggests that Sue is highlighting a critical architectural reality that many software-focused analysts completely overlook. In a modern AI data center, the GPU does not operate in a vacuum. Every high-performance GPU cluster requires a highly capable host CPU to handle data preprocessing, manage system memory, orchestrate network traffic, and run the broader non-AI application logic. If you pair a state-of-the-art AI accelerator with an underpowered or outdated CPU, you create a massive system bottleneck, essentially paying millions of dollars for idle GPU compute cycles. This is where AMD's dual portfolio becomes an incredibly powerful strategic moat. Unlike NVIDIA, which has historically relied on third-party x86 CPUs or its own newer ARM-based Grace chips, AMD is an established powerhouse in the x86 server market with its EPYC lineup. By offering a tightly integrated, validated stack of both market-leading CPUs and highly competitive GPUs, AMD can offer enterprise clients a more cohesive and cost-effective platform. This x86 compatibility is crucial because the vast majority of existing enterprise software and database infrastructure is built for x86 architectures. Migrating those workloads to ARM-based systems can introduce significant software porting friction. Therefore, AMD's CPU business isn't just additive in a financial sense, it is a vital Trojan horse that helps pull through their higher-margin GPU sales. But how exactly are enterprise customers navigating these complex multi-million-dollar infrastructure decisions as they plan for the future? That was the exact question that prompted the next major turn in the conversation, as Carl Quintanilla pushed Sue to explain the current mindset of corporate buyers. Quintanilla stepped in to ask about the state of enterprise IT budgets heading into the next fiscal year. He asked Sue whether chief information officers and corporate executives are approaching AI spending with a sense of strict cost discipline, fearing a lack of near-term return on investment, or if they are still in a move fast and break things phase, pushing the pedal to the metal to ensure they do not get left behind by their competitors. He wanted to know how the actual decision-makers are balancing the immense pressure to adopt AI with the harsh reality of corporate balance sheets. Sue's answer painted a highly pragmatic picture of the enterprise landscape. She observed that it is not a simple binary choice, rather, companies are actively trying to do both. On one hand, there is still an immense appetite to use AI as a tool to drive corporate productivity, leading to widespread experimentation with different models to see which ones yield the best business outcomes. On the other hand, she admitted that the absolute costs of running these AI systems are becoming so massive that corporate leaders can no longer afford to write blank checks. Sue made a highly compelling comparison, stating that companies must now manage their AI compute costs with the same level of discipline and scrutiny that they apply to managing their employee headcount costs. To navigate this financial reality, she predicted that the future will not be dominated by a single massive model. Instead, she foresees a highly diversified approach where enterprises utilize a strategic mix of the largest proprietary foundational models, open-source models, and highly targeted small to medium-sized models customized for specific corporate use cases. This compute cost as headcount cost analogy is, in my view, the single most important takeaway from the entire interview. It signals that the initial, speculative gold rush phase of the AI cycle is officially maturing into an operational phase focused on unit economics and return on investment. When a CEO of a major semiconductor firm acknowledges that AI costs must be managed like payroll, it means enterprise buyers are starting to demand efficiency over raw, unbridled power. This shift has massive implications for the chip industry. During the training phase of AI, raw performance at any cost was the only metric that mattered, which naturally favored NVIDIA's premium-priced hardware and proprietary CUDA ecosystem. But in the inference and production phase, cost per query and hardware utilization rates become the dominant metrics. If an enterprise can run a medium-sized open-source model on a cluster of AMD's more cost-effective hardware and get 90% of the performance of a massive proprietary model at a fraction of the cost, they will make that trade-off every single time. This is why AMD's open ecosystem strategy, built around the open-source ROCm software platform, is so crucial. By offering competitive pricing on their hardware and actively supporting open-source models, AMD is positioning itself as the rational, cost-conscious choice for enterprises that are moving past the hype and looking to optimize their operational expenditures. This shift in enterprise priority from raw training capacity to highly disciplined operational efficiency brings us back to the core argument of Sue's discussion. The battle for AI dominance is no longer just a sprint to build the largest supercomputer. It has evolved into a marathon of architectural efficiency and cost management. AMD's unique positioning lies in its ability to address both sides of this coin. They have developed the high-end GPU power necessary to win over massive hyperscalers like Meta and Microsoft, while simultaneously leveraging their legacy x86 CPU dominance to capture the massive wave of enterprise workloads transitioning into production. Wall Street's short-term anxiety over margin dilution or minor quarterly fluctuations seems to miss this broader structural transformation. By treating compute as an ongoing operational expense akin to human labor, the corporate world is demanding a more balanced, multi-vendor silicon ecosystem. As the industry marches toward that projected $2 trillion market by the end of the decade, the true winners will not be those who simply sell the most expensive silicon, but those who can help enterprises scale their intelligence without breaking their budgets. The coming quarters will prove whether AMD can scale its supply chain fast enough to meet this massive wave of production-level demand. The real test is not just whether they can manufacture enough chips, but whether they can sustain the software maturity required to keep those enterprise workloads running smoothly without a hitch. If they manage that, the current valuation gap between them and the market leaders will look like an enormous oversight. We are watching the transition from a speculative AI gold rush into a practical industrial-scale build-out, and that is where the most durable value will be created. Thanks for watching. If you enjoyed this one, make sure to like the video and subscribe to the channel. See you in the next one.